This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, we'll be going through Oceania Healthcare's FY2022 report. I'll be going through some of the key points that I think are important, as well as detailing how I'm thinking about my investment in Oceania Healthcare, given that it's the largest position in my private as well as in my public sharesies portfolio, which I talk about on this YouTube channel. So if you enjoyed today's analysis, be sure to hit like and subscribe and check out the links down below. First one is Easy Crypto. Sign up with Easy Crypto, place an order and get $10 off your first order. As well as that, we have Interactive Brokers, which is one of the cheapest platforms out there to buy overseas stocks in the US, in Australia, and everywhere else. So check those links down below. As always, none of this is financial advice. And with that out of the way, let's get right into the video. So over here, we have Oceania Healthcare's share price. They are currently trading at $1.04. As of recording, you can see that the share price is down 22.39% year to date, and it traded as low as 95 cents per share before recovering back up to $1.04 after announcing the results. So to give you a little bit of background on the economic backdrop, the macro backdrop, firstly, the share price has suffered because of the housing market in New Zealand cooling down, as well as inflation in labor costs and building materials. So that will definitely impact development margin going forward, as well as resale margins with the cooling housing market. And secondly, there's also an impact on care earnings as a result of the aged care pressure with underfunding from the government. So this is why the share price is down 22% year to date, as well as all the other retirement village operators in the industry also suffering a similar fate. So here's a high level view of the earnings of the business. On the face of things, it looks pretty good. We see underlying EBITDA increasing by 16% year on year, and we also see DMF increasing by 30%. And the care premiumization, which was the strategy that they had, is to convert their older beds, their standard care beds, into premium care beds to increase their premium revenues, as well as converting some of the beds into care suites where they can charge DMF. So that is what their care revenue, their premium care revenue is all about. And that is currently at 18.9 million, an increase of 24% on the prior comparable period. So overall, on the face of things, the numbers look big, the growth looks big, everything is fine. We see Aura sales in FY22 at 450, new sales comprising 184 of those Aura sales, and resales 266. So overall, a pretty decent result. Development margin at 28% is also relatively high compared to the other operators out there as well. In terms of the development pipeline, they did signal that going into FY 2023, the guidance they gave on build rate was over 300. And going forward, they also expect to deliver 300 plus units every year. So that will be something to keep an eye on. In terms of the banking facilities, they've increased it from 350 to 500 million, and they've managed to secure that additional 150 million for 5 years out to FY 2028. So that will help them with their growth plans going forward. Now, in terms of the final dividend, they did announce an increase in the dividend from 2.1 to 2.3 cents per share. So this brings the total FY 2022 dividends to 4.4 cents per share. So at the current share price, it's about a 4.2% dividend yield, which is not too bad at all. So this represents a 55% payout ratio on the underlying net profit after tax. Now, if we look at the underlying net profit after tax, it currently sits at 56.7 million, which is a 15% increase year over year. Now, consensus analyst estimates for underlying earnings going into the results was at 53.7 million. So they definitely did beat the analyst estimates, and it does look like this was a pretty decent result overall. However, you have to consider that they have increased their share count by 13.5%. So the increase in share count is a result of them making the Waterford acquisition, so they did raise capital for that. And as a result of that, if you adjust the earnings by the number of shares outstanding, FY22 EPS was at 8 cents per share, and FY21 EPS was at 7.8 cents per share. So that is only an increase of 0.2 cents per share, and that is around a 2% increase, right? So 2 plus 13.5 is roughly the 15.7% increase in underlying net profit after tax. So when you look at it from that lens, the underlying net profit after tax was not spectacular at all, and that is underperforming inflation at 6 or 7, 8% in New Zealand. So as a shareholder, you definitely do not want companies to be issuing new shares, because overall that could potentially be dilutive to EPS. So 2 cents increase is not spectacular whatsoever. Now, if we look at the margins over the past few years, we see the EBITDA margin of aged care actually coming down quite substantially. When they listed in 2017, the EBITDA margin was at 21%, and it hit a low of 11%, and now it's stabilizing at 12%. Now, this is obviously due to a few factors that was not really within Oceania Healthcare's control. 3 things. Firstly is the underfunding from the government. Secondly is the nursing shortages as a result of the closed borders and stuff like that. And as well as that, there's direct costs involved with COVID. So 2.5 million was attributed to COVID-19. And going forward, they do not expect to incur this cost anymore. So in the next 2 to 3 years, the CFO did mention that they do expect their care profit to increase, their care margins to increase, as these costs from COVID alleviate. Another key thing to note is that they changed their strategy. Instead of focusing on the premiumization of care, they are now looking to focus on independent living builds. And this is a good move in my opinion, because it does mean that the company doesn't have as much exposure to care. They aren't as much reliant on the government to increase the funding provided to match inflation. They can focus more on building good products, selling them, making that development margin, and making decent resale gains when those units go up in value over time. So this is a good move, and we've seen their acquisitions, especially in recent years, with Remuera Rise, with Bream Bay, as well as Waterford, all having a higher skew towards independent living units, or ILUs, instead of the care side of things. So this is a good move in my opinion. Looking at gearing, currently the company has a gearing ratio of 32%. This compares to Ryman, which is sitting at 42%, and Somerset at 28%. Now, in terms of the outlook, management did say that they have fixed price contracts out to December 2024 in terms of their construction. So what this means is that the development margins should stay relatively steady, even though we have seen a significant amount of inflation in construction materials. That is definitely a very big positive for Oceania Healthcare, and the CEO did also say that the market will move away from fixed price contracts to a mix of fixed plus variable cost. So in the next few years, no issues there for construction costs, hopefully. Now, the management did also say that the funding gap of nurse wages versus the DHB is wide, and there's nothing in the budget 2022 to give management confidence that this issue will be addressed. Now, I also listened in on the Ryman Healthcare conference call, and they said that there wasn't enough detail to know whether they'll get any benefits out of the budget in 2022. So that's something to note as well. So in other words, I don't think there's much in budget 2022 to resolve this funding gap that they always talk about, right? So this will be an issue going forward into the next year. And normally CapEx is around 120 million, but with the increasing build rate, as they mentioned before, CapEx is expected to be over 160 million, especially in building new units. So this is the outlook for the business. So there's some good and there's some bad. But in terms of my key thoughts about the business, there's a few key concerns that I really have with the business. The first one is the change in strategy to focus on ILUs signals that their previous premiumization strategy is inferior. So over here I have a section from the presentation on the aged care underlying EBITDA, and you can see that over the past year, the underlying aged care EBITDA has increased by 700,000 from 21.3 million to 22.1 million. So that's an increase of about 3%, which is well below inflation. On the conference call as well, the management did say that like-for-like unit prices for care suites has increased by 1 to 2%. So it does show that there's really no pricing power in aged care. So another reason why I think care expenses will be a drag for a relatively long time is because once the borders reopen, once travel becomes more normal, people, I think, will leave New Zealand. And there's already reports on this, and a lot of people are moving to Australia for better wages as well as a lower cost of living. So in Australia, the average registered nurse salary is 80,000 per year, and that's in Aussie dollars, by the way. In New Zealand, the average registered net salary is 68,000. So that is definitely a headwind for the industry. Another area of concern is their build rate. So they say they're going to build more than 300 units per year over the next few years. Now, 300 plus is an easy target for FY 2023 because they delayed Lady Alum that was expected to be delivered in 2022. And that has made 300 plus to be an easy target in 2023, but whether they can achieve that in 2024 is a different story. So that's something to think about as well. Scaling up development is not easy, right? Especially in this current environment. So we'll see how Oceania delivers going forward into 2024. Time will tell how well they do. Another issue that I have with the company is their capital structure. So they have a dividend policy of 55% of underlying net profit after tax. But with the low revaluations that the business has because of their high care assets, as well as the M&A and the increasing build rates, they will need more capital. And what that means is that this will cause significant strain on their balance sheet because they're paying out dividends at a relatively high rate. They have lower revaluations, which will not increase their asset base fast enough to match their increasing borrowings. And they also have that random M&A opportunity that might take up a lot of their capital. As well as that, Oceania favors smaller sites and higher density sites. And what that means is that when you're building up these sites, there will be higher peak capex. This will have a significant strain on the capital structure, their move towards ILUs. And so what that means is that the company will either have to raise capital for future acquisitions or future developments, or reduce the dividends that they pay. So they might pay out 30% instead of 55%, like what Ryman did. Ryman historically paid 50% of their underlying net profit after tax, but in the last year they have announced that they basically want to reduce their dividend policy so that they can, build more and not cause a strain on their balance sheet, because they're already at a 42% gearing ratio. So compared to the industry, they are relatively high, and I see Oceania Healthcare having a similar issue. Paying out 55% underlying net profit after tax is unsustainable in my opinion. So they'll either have to raise capital for future acquisitions, which is something I do not want to see, and secondly, they also have to reduce dividends, which is something I don't want to see either. So this is something of an area of concern, and we won't really see what happens to this until that gearing ratio starts to go up and up and up. Now it's at 32%, which is still manageable, but once it hits 40%, then there might be strains on their future developments. So that's something to keep an eye on. All right, so these are my areas of concern. Lastly, I want to talk about valuation. So currently the share price is $1.04. Their NTA per share is $1.32 per share. So there's a relatively big discount on their NTA per share. Now, if we look at their underlying earnings, they delivered $56.7 million, and their underlying PE based on their current share price is around 13 times, which is relatively low. It's not an expensive stock by any means, and the current dividend yield is 4.2%. So overall, the valuation metrics for Oceania Healthcare is very undemanding. And with a 4.2% dividend, which might go down if they reduce their payout ratio, it's still pretty decent in my opinion. So because of such undemanding valuations, I wouldn't mind holding Oceania Healthcare, but I'll be using any opportunity in the future when the share price goes up to trim my position, because my investment thesis in Oceania Healthcare has fundamentally changed. First of all, the care business relative to the retirement village business is quite underwhelming. And so I think, with what's happened with COVID, it's not really Oceania's fault, but because of the current situation, the care business is a drag on the company as a whole. Overall, the company makes most of its money from development and resale gains, and I think that's what the company should focus on, which is what the company is pivoting to. However, with that in mind, the current capital structure, I think, is not sustainable, cause them to issue more shares in the future. And I don't like that. I want the company to pay me dividends. I don't want them to issue me more shares. So that's my thoughts on Oceania Healthcare overall. Hopefully you enjoyed the video. If you did, be sure to hit like, subscribe. Let me know in the comment section down below as well. Thank you guys for watching. Until next time, take care.